Inflation is at an all-time high, and what the Federal Reserve is doing to fight inflation is raise back up interest rates to slow down the pace that inflation is at right now. And in this video, I'm going to talk about whether it's even worth it to invest in the bond market. Hi, my name is Pascal Manigan, and you're watching the Financial Ownership Podcast. The thing is, one thing you want to think about whenever you think about any sort of fixed income, whether it's a bond or an annuity or whatever it is that just gives a fixed rate of return. Fixed income always does worse in periods of high inflation. And the reason of that is because, let's say, for example, you have $100,000. And say with that $100,000, you get a 5% rate of return. So that's $5,000 that you get. Let's say it's guaranteed. Let's say you have an annuity and it's guaranteed. That $5,000 buys less every single year over time because as inflation goes up, that $5,000 is worth less year after year. So that's when it comes to fixed income. Whenever you have money in fixed income, inflation always has an effect on it. So sometimes people will say things that if you have a fixed rate of return or you have a guaranteed rate of return, there's no risk at all associated with it. That's not necessarily true because there's a risk of every single position that you put your money in, whether you're getting some guaranteed rate of return or if you're dealing with market upswings. There's always some type of economic risk when it comes to putting a position or putting any type of position when it comes to your money. That doesn't necessarily mean that it's a bad thing to do or it's a bad thing to do with your money, and I'm going to dive a little bit deeper into that. But essentially, that's like losing value in your portfolio, whether it's like a stock portfolio or a bond portfolio. It's essentially the same thing when you lose some sort of value from your portfolio because you're losing purchasing power every single year. Just like you might have to deal with market crashes and fluctuations when it comes to investing in the stock market. But when it comes to fixed income or guaranteed income, you have to deal with the risk of inflation and knowing that your money is getting worth less over time. So let's start with some of the reasons on why it might not be the best idea, or what some people might say why you shouldn't invest in bonds. So if you look at the bond market in comparison to the stock market historically returns significantly more than the bond market. So if you compare things like the S&P 500 to the high grade bond market, whether it's government bonds, high grade corporate bonds, and things of that sort, the stock market historically returns more in the long term. So if you ever listen to, say, Dave Ramsey talk about the bond and the stock market and the difference between the two, he'll say that it doesn't even make sense to invest into bonds because you look at the long-term performance of it, the stock market returns more. Well, to some extent, he's right. The stock market does return more. That is true. And also, to take it even further, the stock market is actually a much better hedge against inflation than the bond market. Well, the bond market actually isn't a hedge against inflation at all because it's categorized as fixed income, and anything that's fixed isn't a hedge against inflation. The stock market is a hedge against inflation because usually when inflation goes up, so does the stock market. Because if you think about it, what do companies do when they're selling products or different types of services when inflation is higher? They're probably going to end up selling that product to you, the consumer, at a higher price too as well, which also increases their value of their company and all that type of stuff. And that's why in periods of high inflation, sometimes things like common stocks of good companies and the S&P 500 go up in periods of high inflation because of that. So there raises the big question, why would you ever invest in the bond market if what Dave Ramsey is saying is right to some extent? Well, the reason is why you would want to invest in the bond market is something that I've mentioned in some previous videos. And it's a very important concept. And that concept is known as the standard deviation. And that's the biggest difference between the stock and the bond market. And really, what that really tells you is basically 70% of the time, a certain asset class will fluctuate in value a certain percentage. So let me give you an example to make it simple. So for the stock market, the standard deviation of the S&P 500, the top 500 companies in the US, the standard deviation is about 15. If you look at some of the higher grade bond funds, whether you're talking about things like government bonds and some high rated or prime rated bonds, some of these have a standard deviation of less than 5%. And basically what that means is either up or down 70% of the time, that asset is either going to fluctuate between, in relation to the stock market, it's going to fluctuate between either up or down around 15% within that frame. And for the bond market, it's going to fluctuate around 5% within that frame, either up or down. And the thing is, it's really important when you're trying to take, say, something like lifetime income from your retirement account or your portfolio, that your portfolio doesn't fluctuate too much. You might have heard of something called the 4% rule, basically meaning that you take 4% of whatever you have in your portfolio, and you basically take that out for life. That will not work in an entire stock fund. If you're just using a stock market fund, you're putting yourself at extreme risk of a correction in the market. And if you're using the 4% rule, taking out 4% of your asset every single year, you could end up running out of money. And that's kind of the purpose of using bonds. It's kind of a volatility control. It's just to limit the risk of your portfolio fluctuating a large amount over time. Especially when you have immediate needs for your money, you really want to make sure that your portfolio doesn't fluctuate too much. And it might not matter as much if you have, say, a 10, 20-year plan for your money. If you plan on not touching your money for 20 years and you just plan on just getting the average or just dollar cost averaging in an index fund or something like that for 20 years, it's not going to matter if you're not going to take any money from it for a long period of time like that. But it does matter when you have some type of immediate need for money or you need access to your money, because you don't want to have to assume losses on your assets or assume big losses on your assets because it's all in the stock market and you decided to put it in. And especially in an environment like today where the market could crash basically at any point, and there's a lot of indicators saying that there's certain things that are going wrong with the economy, like from things like high inflation and the fact that interest rates are starting to rise, and you don't really know how companies are going to react to that. So there's some indicators that a stock market crash can happen. You never want to try to predict the stock market crash, but what you can do is take certain steps to limit the risk of your portfolio by allocating some of your money into bonds. And actually, what I would say, especially if you're nearing that age where you're trying to take money from your assets or your portfolio, it's going to be even more important to not necessarily have, all of your money hedging against inflation, but it's going to be very important that you limit your risk by mixing some bonds into your portfolio, because you have an immediate need for money and you're not going to be able to deal with some of the big market upswings of, say, 15%. And when you go even to the outliers of some of the market crashes, sometimes it gets even worse than 15%. So you really don't want to have to deal with that, especially when you're taking out money from your portfolio. So that's why it's really important. And you never want to completely discount the concept of having bonds in your portfolio. But if you want to learn about how you could eliminate market risk completely when it comes to the stock and the bond market, but still get the upside of the stock and bond market, I will actually link a video at the end of this that you can watch where you can get access to the upside of both markets without actually having the risk of losing money in it. So if you found some value in this video, go ahead, like, comment, subscribe. I post content like this every single week. So if you are interested in different types of financial concepts and financial products, I highly recommend subscribing to this channel. If you have any questions, feel free to leave a comment below or book a discovery call to ask any question, whether it's about a different financial product or financial concept. And as always, thank you.